Hi, I'm Adrian. Welcome back to Premium Logic Lab. Bitcoin has recently dropped below $73,000. That move alone has triggered a familiar debate. Some are saying this confirms a bear market. Others argue the 4-year cycle is breaking and that Bitcoin could still make new all-time highs into 2026. Today, I want to slow this discussion down because when people talk about Bitcoin cycles, they often mix definitions, causes, and expectations into one emotional conclusion. So instead of asking, is Bitcoin bullish or bearish? Let's ask 3 better questions. What does a Bitcoin bear market actually mean? What usually causes one? And what evidence would we need to see to confirm it? 1. What is a Bitcoin bear market historically? In traditional markets, a bear market is often defined as a 20% decline. That definition does not translate well to Bitcoin. Bitcoin regularly experiences drawdowns of 30 to 50% inside long-term uptrends. Historically, a Bitcoin bear market has 3 characteristics. First, persistent demand deterioration, not just volatility. Second, distribution by long-term holders, not just leveraged traders. Third, macro or liquidity headwinds that last multiple quarters. A single sharp drop does not qualify, even large ones. So the question is not whether price fell. It clearly did. The question is whether structural demand has broken. So far, that evidence is mixed, not definitive. 2. What caused the recent drop? This move did not happen in isolation. The sell-off coincided with a broader risk-off environment. Rising volatility across equities, and one of the largest crypto liquidation events in recent history. More than $2 billion in leveraged crypto positions were forced out in a short window. That matters, because forced liquidations are mechanical, not emotional. They do not reflect long-term conviction changing. They reflect leverage reaching its limits. This is similar to what we see in equity markets when margin requirements rise or volatility spikes. Price falls faster than fundamentals change. So part of this drop was structure, not belief. 3, the 4-year cycle, what still matters, what doesn't. The 4-year cycle is based on Bitcoin's halving when new supply issuance is reduced. Historically, that reduction in supply has preceded large bull markets. But here's the important nuance. The halving still affects supply, but it no longer dominates demand the way it once did. Early cycles were retail-driven. Demand surged in waves of speculation. Today's Bitcoin market is different. We now have spot ETFs, institutional custody, corporate treasury exposure, regulatory clarity in major jurisdictions. This changes how capital enters the system. Instead of explosive retail surges, demand may arrive slower, more regulated, more macro-sensitive. That doesn't kill cycles, it stretches them, which is why some analysts believe the 4-year cycle is not broken, but elongated. A 4-year rhythm becoming a 5 or 6-year rhythm is very different from a cycle ending altogether. 4. Macro, geopolitics, and Bitcoin's identity crisis. Bitcoin today sits at an uncomfortable intersection. It wants to be digital gold, a hedge, a risk asset, and a technological network. In practice, it behaves like all of them at different times. When liquidity tightens or geopolitical uncertainty rises, Bitcoin often trades like a high beta risk asset. When confidence in fiat systems weakens, it trades more like gold. This dual identity creates confusion, especially during transitions. Recent weakness in equities, gold, and silver tells us something important. This was not a Bitcoin-only problem. It was a risk recalibration problem. 5. Mining economics and on-chain structure. Another overlooked piece is mining. After the halving, miners earn less per block. Historically, this creates short-term stress. Some miners sell more BTC to fund operations. Hash rate adjusts. Less efficient players exit. This often happens before long-term supply scarcity asserts itself. So, miner-related selling pressure early in a post-halving phase is not unusual. It doesn't imply collapse. It implies adjustment. 6. Where could a bottom realistically form? This is where people want certainty, and where we must resist it. Historically, Bitcoin bear phase bottoms often form near major cost bases, prior consolidation zones, areas where long-term holders historically accumulate. That puts a broad structural zone somewhere between $50,000 and $70,000. That is not a forecast. It is a reference range. Markets don't move because levels are magical. They move because participants behave differently at those levels. 7. Scenario-based probabilities, not advice. Let's talk probabilities, not predictions. Scenario 1, extended consolidation, about 40%. Bitcoin trades sideways or lower for months as leverage resets and demand rebuilds slowly. Scenario 2, structural bull continuation, about 35%. ETF inflows resume, macro liquidity improves, and Bitcoin pushes higher without following old cycle timing. Scenario 3, deeper bear phase, about 25%. Macro stress intensifies, risk assets reprice lower, and Bitcoin revisits deeper support before stabilizing. Notice something? None of these scenarios are zero. None are guaranteed. That's how real markets work. Final takeaway. Bitcoin falling below $73,000 is significant. But significance does not equal finality. This move reflects leverage unwinding, identity tension, and a market adjusting to a more institutional future. Whether the 4-year cycle is broken or merely evolving will depend on demand behavior, not narratives. And that's why probability beats certainty. In the next video, I'll show how professionals think about Bitcoin volatility and options during periods like this, and why volatility itself is often misunderstood. Thanks for being here.